What's going on, everybody? It's Jeff here. Welcome back to the channel. We have a lot to talk about. Market is a bit choppy as of right now. You're starting to get into that low volume lunchtime. Wanted to come on here and make this video because once again, the media is continuing to portray and push their narrative. In this video, I want to take a deeper dive into what is happening and also what to expect. I want to break everything down for you guys. So let's get right into it. Here we are. We have the market. A little bit of a choppy. You guys see some of these whiplashes just coming back and forth. You're seeing a lot of fake outs happening. As it's very important to zoom out. And there's two things I want to talk about when it comes to zooming out. First of all, we've really just been going back and forth with a fake breakout to the upside, two fake breakouts to the downside, and the market has been completely stagnant. Okay, we are in a bit of a short the pop and also still in a buy the dip. Okay, all of their dip buyers really haven't gone away. You look at SPY, it's been just really hanging around this, like 412, 414 area. You take a look at Apple. Apple is, guys, it's almost at all-time highs. All-time highs were somewhere close to this 183, 184 range, and we're already sitting at 173. It's a very few handful of heavily weighted stocks, Apple, Microsoft, Nvidia, that are really carrying the entire market. Okay, so there's twofold that I want to talk about. First off is, as I just mentioned a little bit, a couple of seconds ago, you still have the buy the dip, right? So buy the dip works until it doesn't. Okay, and if you take a look at the entire market from where we've really been trending, really, you can say October, okay, all the way down here, but it's really ever been since this middle of March, where every single dip has consistently been bought. All right, so until that pattern breaks, like I said, it works until it doesn't. Okay, so it's very important to know where we are on an intraday level. I continue to trade. My long-term portfolio is only a very few stocks. Okay, which obviously some of you guys know exactly what those are, and I'm just continuing to trade in intraday. So intraday, I have that mindset of, listen, dips are continuously getting bought. You're seeing that buying pressure continuously come in, right? But it's also very important to not lose sight of what is happening on the macro, right? What is happening in the entire economy. Now, I am definitely not one of those, heavy bears. It's just like, why is the market up as much as it is? It's got to go down. We've got to get below like sub 300. The market's going to crash. I mean, you watch these doomsday crashers come out ever since, 2020. It's just the constant videos and it's just, eventually they're going to be right? It's like Michael Burry. He comes on, he tweets, oh, it's going to crash. And he, deactivates his Twitter, and then all of a sudden something happens, he comes back. Well, you know what I mean? Like, eventually you throw a dart 1,000 times, eventually you're going to even hit the board, let alone a bullseye. You're going to hit the board, right? So that's kind of what I see when it comes to these doomsdayers. But let's take a look at what exactly is being portrayed. So first of all, producer price index came out today. CPI came out yesterday. Headlines are all over, right? Headlines all over that inflation's going down. Inflation's going down, right? The president's coming out, the government's coming out, spokesperson's coming out. Okay, listen, inflation's going down, prices are going down, Americans are feeling ease, right? They got more money in their pockets. Well, when you take a look at these numbers a little bit closer, all right, and I'm gonna break this down for you. It's solely focused on this headline number, 4.9%, and as it's less, year over year, right? That big number keeps going down, right? From 5.5 to 5.1 to 4.9 and so forth, right? So everybody's like, oh my God, it's going down, it's going down. Well, first of all, let's just say the 4.9 is very high. We still have a long way to go, okay? And the lagging effects of rate hikes have not hit as of yet, okay? That's one. Two, Americans' two biggest monthly expenses are food, right here, food, 7.7%, and shelter, 8.1%. Okay. It is totally, if you look at what is pulling that number down, right? What is the biggest sector that is weighing this number down? It's energy, right? And it's mainly gasoline. We've talked about this from time to time. You look at this huge spike in gas prices, the way they do this calculation, as long as gas prices stay constant, anywhere between 350, 370, somewhere in that range, it's going to be negative, right? You look at where we were in May, 469, getting up into June, 497. So you look at these next two CPIs, energy is going to be pulling down that number drastically. Okay. You might even see negative 20%, maybe see negative 30%, maybe even negative 33%. Who knows? All right. But it's going to pull down that number. So it's pitching the whole entire narrative of, listen, like, it's coming down, it's coming down, it's coming down, right? Inflation's coming down. But if you zoom out just a little bit further, and this chart, in my opinion, shows things a little bit clearer. Okay. This is core CPI. Okay, and this is all items. Well, it actually shows everything, but what we're focused on is core CPI, which is this line item right here. Okay, all these sixes and fives. This is all items less food and energy. Right now, while food obviously is one of the two biggest monthly expenses that Americans have, and energy is probably very close up there with it. Okay, if not number 3 or 4. The reason why they remove those two is to find a little bit more consistent of a trend, is because those two tend to fluctuate wildly, right? You've got, the price of eggs are, $1.89 a dozen, then they get up to $6 a dozen, and then 2 months later, they're back down to $3 a dozen. Like, it's very, very wild. Same thing with gasoline. We've watched it ramp from, where I am, at least in the Northeast, up to around like $2.20 a gallon, all the way up to, $4.70 a gallon. Right now, it's probably sitting at around $3.15 to $3.20 a gallon, for 87, right? So it tends to be very, very volatile. And that's really why I like to segment it. But if you take a look at just a little more consistency, and this number came in at 5.5%, right? Which is down 0.1% month over month, which is even from February. And then you've got 5.6, even up to 5.7. So we are looking back at the last 6 months all the way to November, and we have gone down less than 10%. So a 10% drop from 6% would have been 5.4. Inflation, core CPI, core inflation, okay, has gone down to less than 10% in 6 months. So if we continue at this pace, we are looking at trying, 2025 maybe, in order for inflation to get down, right? And that's the core CPI, which was energy is not going to be able to have an impact, right? What we just talked about, okay, how the huge spikes, last year are going to bring down that headline number, which is what everyone's going to be talking about, right? This is a pre-election year, guys. Okay, it's getting big and heavy. It's what their narrative they want to focus on. So, like I said, guys, it's really important not to lose touch of the macro. There's been some amazing plays, on larger time frames. Absolutely amazing plays. Okay, you look at where Apple hit off of the bottom. You look at where AMD was off of close to that $50 range, that $55 range. Shit, you look at Nvidia. Nvidia's almost at $300 and it bounced off that 110. Tesla, we have some amazing long plays, right? And that's why it's very important to kind of segment. I really say segment 3 things. One is the macro, the economics, what's going on, also what the chart is telling you. All right. Sometimes it might be hesitant to be able to get into a long because you're thinking, listen, the chart looks good. However, the macros are bad. I don't want to fully expose myself to get long. And that all comes into position sizing, dollar cost averaging, understanding where your stops are going to be, right? And then the third factor of that is kind of drowning out the noise of when you have these doomsdayers of like, everything's going to crash, everything's going to crash. Just realize that even though if you might be focused on it right now, they've been saying the same thing for years. Okay, I wasn't heavily active, obviously, on Twitter, YouTube, in Discords, back when I started, trading and or really got heavier in day trading, probably 2016, 2017. But it was the same thing. You would read it in the headlines, you would see it on TV, you only see it everywhere. Okay, so it's always been, and eventually they're going to be right. So it's very important to segment those things. Last thing I want to talk about is what is happening right now when it comes to regional banks. Okay, so this is just a couple hours ago. PacWest deposits dropped 9.5% after a report of investor talk. So currently, Pacific Western Bank is kind of experiencing what we call a bank run. Okay, it's where, listen, you've watched these banks go under. Okay, obviously, got bought out, by JP Morgan. The FDIC had stepped in, the government had stepped in and seized the other ones, trying to, really, kind of help out investors and say, listen, even if you're uninsured or your money's gonna be safe in the banking system, the government really needs to make sure of that. But these banks are under a lot of trouble. If you take a look at the entire banking ETF. Look at this chart over the last year. You've had some of these, dip into these October lows. It got recovered. Look at this huge sell-off coming right here into March when all of this, drama started happening. You're starting to see a little bit of an H pattern, which obviously if it breaks this 30, then that's going to be some serious trouble. Even more focused is this right here, this ETF, KRE. All right. And this is the regional banking ETF. Try to zoom in even more for you guys. Let's just go to a weekly chart here. Make it even easier. Look at this chart. Okay, look at this. Look at these. Look at this selling pressure. You go back all the way to COVID. Okay, this is COVID times when everything was going crazy. There still wasn't even that much selling pressure. I know it might be hard to see. You're gonna have to pull this chart up on your own, guys, to really get a good look at this volume. But look at this selling pressure. There's nothing stepping in to show signs of, listen, like relief, recovery, like action, nothing. And this is a specific regional banking ETF. Okay, so it's very important, like I said, to keep this on your mind. Don't solely focus on listen, it's got to go down. We're going to go down because everything that's happening in the macro. You know, the stock market can really hold longer than you can stay solvent. Okay, you know that, and it's really crazy to see because I've watched it time and time again. I've watched charts that are just, you know, you're watching Nvidia, for example, where it's like it's, to my opinion, by watching is, it's not even the buying pressure that is making the stock go higher. It's literally shorts continuously tripping over themselves. So guys, it's just very important. Like I said, we do have, you know, information that is going to continue to come out and be released to us. All right, until the market really breaks this range, just know we are going to be very, very trappy. Okay, inside this, I'll zoom in a bit for you. Inside this range that we've just really just been ping-ponging back for quite some time, very choppy. And like I said, guys, buy the dip. It remains to be, you know, the MO, and you're still kind of selling these pots, but it's buy the dips, you know, remains it until it doesn't work. So until that flips, until the structure completely flips, you have to keep that in the back of your mind. So guys, I hope this video helped you. I'll see you in the next one.